Suderman, Chief Commodities Economist at StoneX, and it's good to have you with us today. Water report from USDA. First of all, I want to apologize starting a couple minutes late here. We had some technical difficulties, but I think we've got enough of them worked out that we can go ahead and proceed. And we've got a lot of territory to cover today. If you look back at the history of USDA surprises, this one ranks up there pretty high. And so let's talk about it. First of all, I do need to get the disclaimer slide up there and keep our folks in compliance happy, give you an opportunity to read this and to study it, should you like. But basically, USDA coming into this, there's two reports. There's the acreage report and the quarterly stocks report, both surveys done around June the 1st, thereabouts. And if anything, is a fairly normal planting season. And so we thought that there would not be any big surprises in the acreage report. Neither did the trade think that. Yes, we did expect a little bit of an increase. Yes, increase in soybean acres. We expected corn acres to stay pretty close to unchanged. Because, yeah, corn planting went in a little faster than normal, and that usually picks up a few acres. But we had some what we felt would be some prevent plant up in the northwestern ag belt in the Dakotas, Minnesota, along the northern Red River Valley. We thought that might pull some acres out. So overall, we thought that would balance out. We thought we'd lose some cotton acres. And with all the winter wheat abandonment, we thought we'd pick up quite a bit of sorghum acres and soybean acres. Where we picked up the sorghum acres, wow, we picked up a lot of corn acres and lost a ton of soybean acres. So the missing soybean acres is the big discussion. So let's get started. First of all, price is a function of supply and demand as modified by the flow of money. So money flow has a big difference on how the market interprets these numbers. So we're going to go into briefly how that is. And I took out some slides here to give us some more time on some of the other things. But I still think it's important to look at the money flow atmosphere. We came into this report with a generally risk-on type of an attitude on Wall Street, affecting the equities and affecting the major commodity prices. And that comes after a period of time when we've been seeing a very rapid increase by the Fed in their benchmark short-term interest rate. And here you see how that interest rate has climbed up. If we look at Fed fund futures trading earlier today, it was showing about 80% odds that we're going to see another rate hike on the July Fed meeting. And in fact, I think later in the day, these odds grew even stronger. And in fact, if you look at those odds, they were growing to about 35% or so that we might see an additional rate hike later in the year, maybe at the November meeting. And in fact, this week, Fed Chair Jerome Powell stated that the majority of the Fed members felt like we probably would need a couple more rate hikes or more yet this year. And then it drops off. Originally, we were talking this week about maybe dropping off to 375. Then today it was more like $4. But it's really in that 375 to $4 area, 4% area by the end of next year. So the market is expecting big rate cuts next year. And the Fed is kind of, suggested we'll see our first rate cuts next year. I don't think to this extent unless things change dramatically. But Wall Street's growing accustomed, and Wall Street's in pivot mode already. Wall Street thinks that the worst is behind us. And the commodity markets, to the most point, are still worried about seeing that recession that hurts demand for commodities. And we've certainly seen that to a great extent in the energies. We certainly have seen it in the grain and oil seeds in the U.S. because the dollar has been so strong, for one thing, and the geopolitical tensions between us and China haven't helped either. That's kind of the backdrop of this. We keep pushing the anticipated recession later and later. It just keeps shifting later and later. And now Wall Street's wondering, are we even going to have a recession? I still believe, even though this morning's PCE numbers are trending lower, that in order to get wage inflation down, which is going to be necessary, I believe, to hit the 2% target for overall inflation, that you're going to have some type of a recession. It may not be a severe recession by any means, but I think we're going to have one. That's if we stick with the 2% target. But let's move on. The big problem is still the labor sector, and the labor sector is still looking tight. We'll get an updated jobs report next week on Friday. So up to see what that shows. But to this point, the labor data has really been reflecting a tight labor market. Now, when interest rates go up, what we've been seeing is managed money, speculative money coming out of the commodity sector. Here's a graphic showing West Texas Intermediate crude oil managed money versus the Fed funds rate. Very much of an inverse relationship there. Now let's look at the ags. This has the grain and oil seeds and the livestock on it. Same type of a pattern here. So the thinking has been for about the last 13 months or so that if the Fed's going to raise rates this fast, that's going to throw us into a recession that hurts demand for these commodities. And that's been the kind of the prism that fund managers have been looking at supply and demand fundamentals through. That provides the backdrop. So let's look at this relationship between inflation expectations and the commodities. Here, the blue line is our StoneX commodity index. It's a basket of commodities, including the grain and oil seeds, including livestock, including the energies, including the softs, including precious metals, including industrial metals. And we just follow the value of that basket. And here we track it against the 5-year break-even inflation rate. That's what the market believes inflation is going to average over the next 5 years. And note that the 5-year break-even inflation rate being traded by the markets right now is just barely above 2%, that 2% mandate. But notice also that they move up and down together. There's a little bit of a lag effect where the commodities lag what market expectations are on inflation, but they move together. And in fact, I circled there at the bottom, the correlation between the two over the last 10 years, and that's quite a period of time to correlate, is 0.88. That's a very strong statistical correlation. We generally think anything over 0.7 is considered a strong correlation. So when market expectations are that inflation is going to be rising in the years to come, they want to have ownership of the commodities. Money flows into the commodities. When they expect inflation to be going down and maybe even recession, they tend to pull money out of the commodities. That then provides the backdrop for this report. Now, I want to talk briefly about Ukraine. I'm probably not going to spend any time on China necessarily today, but I did want to address what happened last weekend in Russia briefly. And that was that we saw the mercenary army, said to be around 25,000 troops, that had given Putin his only victory in the last 6 or 8 months by taking the city in eastern Ukraine. He marched him back into Russia to the city there on the south that I can't pronounce, Rostov-on-Don, where the Ukrainian war effort was being managed from that city, took over that city, marched north, and was heading toward Moscow, and got within about 125 miles or so of Moscow. And all of a sudden, he stops and says, just kidding. Well, no, you don't do that in Russia. There's all kinds of rumors going around about what actually happened to him. Was he exiled to Belarus? Was he killed? And they've got a fake guy who looks like him now in Belarus. Or, what's the story on that? But here is what we can anticipate based on what analysts who study Russia say. This ain't over. This is not over. And in Russia, there are 3 things that keep you in power, speaking of President Putin right now. First of all, unity of the people, the population base. And that's not real strong right now with all the body bags coming back from Ukraine and with the economy hurting as it is because of the sanctions of the West against Russia. Number 2, a unity of the elite party. And there's some indications that that might not be doing well as well. Number three, fear. That fear is a key component to keeping a president in power in Russia. And President Putin faced a problem. His best fighting force in Ukraine was now following a rebel, but he needs that fighting force in Ukraine. So he couldn't openly just kill the commander of that fighter force. He couldn't charge him with high crimes publicly, nor could he charge the members of that military unit with high crimes, because he needs them in Ukraine. They're the only ones who are winning battles. He needs them. So he kind of said, oh, no charges are dropped. Now, whether that's true or not, I don't know, but that's the public statement. And what does that do to the level of fear? It says, hey, somebody can stand up to President Putin and live to tell about it. So he has to reestablish his leadership in Russia domestically and in the world of the public opinion of world affairs here, in the world view. So the question is, what is he going to do to reassert himself as being in control domestically and in the Ukraine war? What unconventional steps might he take to do that could have an impact on commodity trade coming out of that region? Now, we're generally expecting, we're generally expecting that exports out of Ukraine are going to continue to struggle. Don't have the June numbers yet, but the unofficial numbers look like it's going to be closer to 3.5 million metric tons of total exports out of Ukraine. It's becoming more difficult over land. It's becoming more difficult out of the 3 approved ports. The grain initiative that allows grain to move out of the 3 ports, it looks like won't be extended past July 17th. And even until then, it's a very slow movement of grain. So that's going to be a continued concern. The market's adjusting to that. What the market is not adjusted to is the possibility that if Putin would do something radical that might really turn the world on him, we might see a stoppage of commodities, or at least a dramatic slowing of commodities coming out of Russia. Now, I'm not predicting that, but I'm saying that is a risk that we need to be watching as Putin tries to reestablish himself. Now, let's move on now and talk about weather. That's been a big part of the story in recent weeks. And here are the factors that are driving the weather right now. We got the rapidly developing El Nino. We have very warm waters in the northern Pacific. So let me use my marker here. So rapidly warming temperatures here, giving us an El Nino. Rapidly warm temperatures here, but very cool temperatures in here. We call that a negative PMM. And that has not been the dominant force. If that becomes a dominant force, then that tends to give us high pressure right here over the Midwest and give us a hot, dry summer. That is still a risk. Now, what we're seeing happen right now really started yesterday was the transition that we expected 2 to 3 weeks ago as we went into a rapidly developing El Nino of a northwesterly flow over the Midwest that gives you these clusters of thunderstorms that provides mild temperatures and adequate rain to produce a good crop of corn and soybeans. It didn't happen 2-3 weeks ago, but it appears to be happening now. And I'm going to show you more on that in a little bit, and that's what we're going to watch. But if that doesn't develop as expected, and the models have been definitely in agreement on that, so there's good model agreement that that's going to happen. What about beyond that 2-week period? Do we go back to the negative PMM being the more dominant factor and we get high pressure building over the Midwest, turns hot and dry? The forecasters don't think so, but that is a possibility. So if we're going to be wrong, that would probably be what we would look at. Again, that's not what's expected. What's expected is a fairly mild and relatively wet July and August that favors healing the crops and getting some decent yields. But we'll have to see how this pans out over the next couple of weeks. Here again is the major grain producing areas of the country, and obviously the major part of the Corn Belt is right in here. And it's more heavily weighted to the northwest side of this. Now, the concerns are that if there's an area of concern that may get missed on adequate rain, we don't expect it to be totally dry, but of getting adequate rain, it would be in this area. That's the concern going forward. So that's what we're going to monitor. Again, I'm not saying a major drought, but if there's any risk here, based on the path that we're currently going, where it may be drier than what we'd like to see and maybe a little warmer than we'd like to see, it would be in that northwestern ag belt. Primarily, if we look, and let me clear this out, primarily in an area like this. That seems to be it. Now, maybe it could shift a little bit to the east or shift to the west, but that's our primary area of concern we want to watch going forward. And I've been saying that for the last month. Okay, now this is last 30 days of rainfall for the Corn Belt. I did not do this today. I did this map midweek this week. Well, actually, I think it was on Tuesday before these latest rains happened, because I wanted to demonstrate where we were at. So for the 30-day period, we were basically wet here in the Western Plains, dry here in the heart of the Midwest, and then wet underneath here. Keep that in mind. When you put it all together, weighted rainfall here, this is about the third driest 30-day period for that time frame, going back to 1979. So that's significant. That's why we saw the crop ratings really dropping. And I'll get back to that and I'll show you that here in a little while. April and May were very dry as well. So here's what I did. I went back and looked at the April and May of this year on precipitation rainfall on the left, and you can see how dry April and May were in the Midwest. And then the map I just showed you showed that was, and that's this map, showed you how dry we stayed for much of June during that time period as well. So this is dry. Now, temperature-wise, we were very warm in here as well. Well, let me clear that. Draw that better down here. Very, very warm. Some cool temperatures up here, but very warm here because of those dry soils. Keep this in mind, okay? April and May, warm and dry across the Midwest. So I went back and looked at the 5 driest April-May periods for the Midwest. And I list those years right here. Now, I went back about 40 years or so to identify those years. And in those years, April and May was very dry here in the Midwest, and it was tended to be cooler in the Southeast. The big difference from this year is this year was warmer in here, and in those years, it tended to be hotter out here. So that was one difference. But other than that, the dryness was the same, the coolness to the south and east was the same, everything else was the same, just missing this dry up here in the northern plains. So then I looked at, okay, in those 5 years, what happened in June and July? So let's move this forward now. Same 5 years to the month of June, looking at temperature. Warm, and that's just how we were this year. And cool to the south, just like we were this year. Roll that forward now to July, and look how we're cool over the heart of the country, including the Midwest. So those 5 driest April-May years verified very nicely in June, and if they continue to verify, we would expect a very mild July. Let's look at rainfall now. Rainfall during the month of June in those years that were driest in April and May tend to be dry in the Midwest in June and wet to the south and a little bit wet to the west. Very much like this year. June played out very well, just exactly how those previous years that were dry in April and May turned out in June. So what about July? How did it roll forward to July? Generally normal to above normal rainfall across the Midwest, with the exception of a few dry pockets up here, which is our area of concern. And so looking at those 5 years that had the driest Aprils and Mays, it really also seems to support what the forecast models are telling us to expect for the month of July. Mild temperatures, normal to above normal rainfall. Now, I do need to say that the type, and I said this a month ago as well, the type of rainfall you can expect in this type of a summer on northwesterly flow is thunderstorm clusters, which means you get some severe storms sometimes. Yesterday was a good example of it. We had a derecho that moved out of Iowa and Missouri into Illinois, and I'll talk more about that later. You can get severe weather, but those are kind of hit and miss systems. You get enough of them, you fill in all the pockets, but you do have the risk of some pockets getting missed. So that's a risk with this type of a system, but overall, you tend to see this pattern. Now let's look at the next 2 weeks. Across the top, we see 3 different model forecasts, all pretty much in agreement. Good rain across central and southern parts of the Midwest. Look at week number 2. Good rain coming down here across the Midwest, maybe some concerns up here to Northwest. Here you see this in this model, the European model as well, that area of concern. It's not totally dry, just below normal, but remember temperatures are also expected to be below normal as well. And then you get to the GFS, it's wetter and generally good rainfall across the entire area, normal to above normal rainfall. So that's the next 2 weeks. So it's what's beyond that is going to be the question if this verifies. Okay? Now let's look at today's numbers. Well, let's start with the stocks numbers, all coming in below trade expectations. In fact, with corn, it was about 150 million bushels below trade expectations. I got to pat myself on the back a little bit. I feel pretty good about my estimates. I only missed that corn estimate by 10 million bushels, whereas the trade missed it by 150 million bushels. So I feel good about this. And here's what I want to say about it. Based on the March quarterly stocks report and now the June quarterly stocks report, my confidence level goes up, and this is what I was looking for after the March report, is that we would eventually get confirmation with this June report that USDA overstated both its corn and soybean crops from 2022, and will likely see a downward revision of both of those crops in the September 30th report. And that we probably were feeding more corn in this current year than USDA indicates. Now, I've made it clear that I think they're overstating corn feeding for the new marketing year. But that gap got narrowed today because I think they're understating feed usage for the current year. And I've made that adjustment, and I'll show you that in my balance sheet. Now let's go to the acreage number, and then I'll pull it all together in my balance sheets. Okay? Let's start off with wheat. Wheat came in a little bit less, about 300,000 acres less than is expected. Well, I'm sorry, let me start over. Total wheat came in only about 28 million acres less than expected. Winter wheat came in 300,000 less than expected. Other spring wheat, hard red spring, white spring, came in considerably, about 600,000 above expectations. And then durum wheat had a big surprise drop there. The scope of the drop is what was surprising. So you think that's enough? We're just getting started. Corn, 94 million acres, up from USDA's 92 million acres in March. And as I said before, we expected the core of the Midwest to see some modest increases because how quickly the crop went in. But we did not see this coming. The highest trade estimate was 93, and I was at 92. And I was above the average trade guess. So I missed it, and didn't miss as bad the trade, but I still missed it. But look at soybeans down 4 million bushel, excuse me, 4 million acres from the March estimate. We didn't see that coming. You'd think if we're going to lose 4 million acres of soybeans, we would see significant signs of that. We did not. And I'll show you kind of where they disappeared from, but that was the big surprise overall. I was expecting an increase. The trade was expecting the increase, but not as big as me. I still didn't have the biggest estimate. But wow, losing 4 million acres from the March estimate, gaining 2 million of corn. Cotton went down, wheat went down. So where's the missing acres? Well, let's move forward here. Here's the corn acreage from the difference from March. Now, the upper number in each state is the current June estimate of acreage. The lower number is the percent change. And virtually all of the Midwest saw an increase from March, except Nebraska, Michigan, and Indiana, which were unchanged, and Kansas and Ohio, which both saw drops. Other than that, the Midwest was basically higher. If we look at soybean planted acreage, virtually everybody in the Midwest saw a decline in soybean acreage, but look at those big 7.4% drop in Illinois. Really? You would have thought we would have picked up on that, and we did not. Now let's look at combined corn and soybean acreage. Virtually the entire Midwest, outside of South Dakota and Minnesota that was unchanged, saw a decrease in corn and soybean acreage decline. Really, in a year when planting really went well, you think we decreased acreage? But these are the numbers that will be traded. And while I may question them, others may question them, I'm putting them in my balance sheet because that's what the market's going to trade. And we need to remember that. Here's a change from the previous year. Okay, crop conditions. Here's the corn crop. You can see that the biggest problems in the corn crop are right here, especially a big X on Illinois, 26% good to excellent versus that's about 40 points below the 5-year average for this week of the year. Everyone I have talked to in Illinois from different sectors of the industry is saying Illinois' corn crop is better than that. Well, especially after this rain, but they were saying that before the rain. I'm just repeating what they're saying. I don't hear that from other states. Other states, they generally say, yeah, that's probably pretty close, etc. Illinois, I hear, yeah, the crop's hurting, but it's not hurting that bad. But, you know, it is what it is. Again, like the acreage numbers, it's what's going to be traded. This is as of this past Sunday's numbers reported on Monday. Now, if we put good, excellent, fair, poor, very poor, all on a condition index score, we get a condition index score of 338 for this week. That is the lowest condition index score for this week of the year since 1988. Well, that says something there. And the blue line up here shows final yield for each of those years. So the correlation is not real strong between June crop conditions and final yield. 1992 was a year that still recovered very nicely when it turned cool and wet in July and August, and the crop healed nicely and it got quite an above trend yield. There are some people making comparisons to 1992. There are some things that are very similar to 1992, but I'm not ready to go there. I'm not ready to say an above trend yield, but I'll have more on that here in a little while. Now, yesterday's derecho really got going in this area and then turned to the south. And so let's draw it like that. So if you take all the corn in that area, that's 10 to 12% of the nation's corn crop. But the area that registered 80 to 100 mile an hour winds was this area right here, which is roughly 1% of the nation's corn crop. And I don't want to devalue or discount the damage that was done in that area because significant damage was done in that area. but this is not a repeat of the 2021 derecho, 2020 derecho. This is not a repeat of that derecho that crossed Iowa and Illinois, not by any means. Was there damage? Yes. Was it as significant as that year? No, it was not. Now, may there be additional derechos? Yes, there very well may be. This is definitely the type of year that tends to favor these derecho type of strong storms. So it's something we're going to have to continue to watch. Here's my balance sheet now. I did not change USDA's old crop and new crop balance sheet. Didn't change them at all. I did change mine to reflect today's stocks numbers. And what I did, a little bit of an increase in imports. I increased feed usage some. Now, I was already higher than USDA on feed usage, but today's numbers gave me reason to add a little bit more on feed usage. Fuel for ethanol, I left where I had it before the report. I'm about 45 million bushels below USDA. Exports, I dropped another 25 million bushels, so now I'm 50 million bushels below USDA. Excuse me, but the real difference is in feed usage. But that puts my ending stocks at 1.5 billion bushels. That's about 50 million bushels larger than USDA. That becomes my beginning stocks number here for the new marketing year. I increased my acreage to 94.1 million acres, and then I used USDA's harvested acreage number that was buried in the report as well. I used a yield of 177. USDA is still at 181.5. We'll see next month whether they choose to reduce that or wait for the August number. Based on crop condition ratings, there's a distinct possibility they'll lower their yield, although they may not go as far as me. We'll have to wait and see. I bumped my feed usage a little bit more because stocks reports do have ramifications, but I'm still 100 million bushels below USDA. Part of the reason I ramped it higher, and I think my feed usage number now is up about 4.4% or 4.1%, something like that, is I'm expecting cheap corn prices, and cheap corn prices tend to increase feed usage, amount of time in the feedlot for cattle, etc. Fuel for ethanol, I also bumped because I think will help the margins for ethanol with the cheaper prices. But exports, I added another 25 million to exports due to cheap prices, but still, I think it's going to be hard to go much above that. That's 275 million bushels below USDA. That gives me ending stocks just below 2.6 billion bushels. Now, it's possible we could still drop the yield more. So I threw a 167 in there, and I end up getting ending stocks of 1.733. So I really have to get in the mid 160s to really start tightening up supplies of new crop corn right now with this amount of acreage. Can we get up to a 183 yield? Yes, we can still, based on what we saw in 1992 with less superior genetics. Will we? I don't think so. That's why I have the 177, but I can't rule it out. And that would give us ending stocks topping 3 billion bushels or 22% stocks to use ratio. Looking at soybeans, we see the same area here that's hurting, although we should see that area show improvement this next week with the rains that are falling. Very similar scenario with crop ratings there. Only 1988 was lower. The difference here, if you look at similar ratings, is there's a lot more years with below trend yields. And that's why I lowered my yield 1 bushel to 51 bushels to the acre. Now, I do want to address briefly the EPA's RVO announcement for blending of biofuels. And I talked to our edible oils team at StoneX. They've been really on top of this. And I've been showing you this graphic that comes from data that comes from them. And I've been telling you that this data was based on plants that we had a very high level of confidence in, that there were other plants that we had lower levels of confidence in, that were in various stages of planning and development. But since our confidence wasn't high on them, we did not include them. And I would say that after that disappointing RVO announcement by the EPA, they tell me these numbers change very little. They're very much like they were before. And that's because those plants we had a high deal of confidence in are still moving forward. We fully expect them to do as they're doing. And so a credit to them for their foresight there. So you can stick with these numbers. And if we look at the feedstocks that are going to be available to them, we see these feedstocks. This really hasn't changed a whole lot, primarily soy oil and canola oil. And the crush projection going out the next 5 years, you see here as well. Good, steady growth in crush, and we're still expecting that. So domestic demand looks to remain solid. And one key that I want to mention that we've seen in the industry, it hasn't been that long back when the renewable diesel plants were saying, you know, can you hold off delivering that soybean oil for a week or two? Because we have plenty right now. That is totally flipped to, can you hurry up and deliver that soy oil because we're running out and the crushing plants can't keep up with the needs to deliver fast enough. That is a very significant change in the fundamentals, and why we've been seeing soybean oil rally here of late. And that has an impact on the soybean market as well. Here's my balance sheet for soybeans. Again, I did not change USDA's numbers, but I did change my numbers to reflect stocks, et cetera. And so I'm down to 209 million bushels of ending stocks at the end of this year, which is a 4.8% stocks to use ratio. USDA's at 5.3. That becomes our beginning stocks then at 209 for the new marketing year. I lowered my yield 1 bushel, and I lowered the acreage to 83.5, used USDA's harvested acreage number. That produces a 4.217 billion bushel crop. I increased imports because we're now going to have to import from Brazil over the coming year. And I may be too low on that number. We'll have to see. My crush number had been higher. I lowered that by 20 million bushels, but we're still 65 million above USDA. My export number, I dropped more yet. I had already been below USDA, and I dropped it another 200 million bushels, not another 200 million, but I am 200 million bushels below USDA on exports. We're just not going to have the bushels. And I think USDA is not fully accounting for what Brazil and Argentina are going to produce in the coming year with an El Nino pattern. That brings my ending stocks for the new marketing year that starts September 1 to 189 million bushels, which is a 4.4% stocks to use ratio, down from this year's 5.3% stocks to use ratio. So that really tightens it up. Now, what if we drop the yield to 47.8 because it turns hot and dry? Well, in that case, we run out of beans. So we did see the market add some risk premium today and trying to slow down crush. But this is going to be an interesting time. There is zero margin for error on the soybean balance sheet right now. Here you see the winter wheat ratings. They've come up quite a bit, but they are what they are. Spring wheat ratings overall looking good, but disappointing. As we look at wheat, not a lot to share here, not a lot of detail here that really is earth-shattering or changes the game any. I do see a little tighter stocks than what USDA does overall. Here's the take-home points. El Nino is here in the Northern Hemisphere summer. So as a result, we're expecting a mild Midwest summer, although rainfall is still in doubt, particularly for that area of concern I outlined in the northwestern 25 to 30% of the ag belt. The low soybean acreage leaves margin for error at 0 for soybeans. The range of corn and soybean yield possibilities remains quite large, but my bias is toward the upper end of that range if weather trends verify. So I'm looking for 177 yield. The range of possibilities is 183 to 167. You could even argue lower than 167. On the corn, it may be USDA's at 52 million. I'm 1 bushel lower at 52 million, at 51 million. I'm 51 bushels per acre. I'm sorry. So I'm toward the upper end of that range. Now, the range I said is large. My bias is toward the upper side, but also let's not forget the geopolitical risks are still rising in 2023. Now, I do want to give another shameless plug again for our Farm Advantage app, which you can learn more about it at farmadvantage.com. Encourage you to check that out. And with that, I will conclude my comments and take a drink here and look at the questions. Vanessa, are we able to communicate? Are you able to read the questions? If not, that was part of our technical difficulties earlier. I will try to do it myself. Okay. And I can't, okay. Can't see them all. Some of them have disappeared. My apologies to that. You can re-enter them if you like. How strong do you think that yesterday's derecho storm and a couple that will occur soon will impact corn and bean new crop? I kind of answered that. To this point, it's not been significant. In the big picture things, obviously local it is, possibility more coming. Mitch says, I've read that the labor market readings are a lagging indicator. Is this true? If it is, would that lead us to believe the Fed will take rates too far, too long? Yes and yes, it is a lagging indicator. Yes, they will probably take things too high, too long. That is their nature. They go down too far, too long. They go up too far, too long. That is their nature. And so when I say what I think they're going to do, I'm basing it on their track record, and I'm basing it on things that they are saying, not necessarily on what they should do. Okay. Ed says, what's the date that would be the drop dead date as it relates to rain helping this seasonal crop? I would say right now is critical. We do have some pockets that have already had their top yield hurt. And really maximum ear size, as far as the girth of the ear, the number of rows of kernels, is set sometime around the V6, V8 time frame, which most of the crop is now getting to, but we're getting the range right now. But if you have corn that's been at that area, okay, what are the opportunities that it has to get that yield back, or at least a portion of that yield back? Number one, it can have a good pollination period if we're mild and wet. Number two is not getting tip back. Normally we see tip pullback where the kernels don't develop on the end of the ear. If you can have good conditions, that won't happen. You can gain yield there. And the other is if we continue mild and with adequate rain through August for the grain fill period, we can get very deep kernels. Kernel depth can really add another 10 to 15% yield very easily. So that's the other area where we can make up some of that yield. But overall, the pluses and minuses, I still think that while we technically can get an above trend yield, and I'm not going to rule it out, despite what Twitterville is telling me I should do, it's still possible. My bias is now that we're going to be below trend, which is why I have the 177 yield. But I'd say that critical time is here over the next couple weeks. It also says, are producers responding to this kind of analysis by hedging their bets more than usual? How would you anticipate their positioning? To a great extent, farmers are being the same as farmers normally are, and that's on both sides of the equator, here in the Midwest as well as in Brazil. And while there are those who have been doing a good job of hedging and protecting their crops, a lot of them, most of them are not. Okay, Ed asks, what would your attitude what would you attribute the big trade miss on these numbers? What did USDA see that the trade missed? Do you suspect all this will be reversed in the next report? Could there be any political motivation? Oh, you're going to get me in trouble, Ed. There's long been accusations of political involvement, and I've talked to people personally. One person in particular who previously worked in USDA who had that bias, that there is a political bias to it. I've had that political bias, but it's pretty difficult to prove. Numbers are still going to be traded as they are. What did the FDA see that the trade missed? That's a good question. I don't know what we missed that the USDA saw. Obviously something, if they're right. Maybe statistical error. They were too low on corn in the March estimate and too high on beans, and then that kind of perpetuated itself in the other direction in the next report. So you offset each other and you're somewhere in between. But, these are the numbers. The next time we get a chance to check these numbers is when the Farm Service Agency numbers come out, maybe in August, but probably in September. We should have a good handle on those. Okay. Ed asks, a different Ed. In the Dakotas, increased corn acres in the Dakotas and heat stress drought in the prime growing area would seem to indicate average corn yields. Would that have a hard time hitting trend? And I think I answered that. Sean Pratt from Canada. Why are you dropping corn and soybean yields if forecasters are anticipating a wet, mild July and August? Because if we weren't wet in July and mild in July and August, Sean, I think we would be in the low to mid 160s. So that's why I'm lowering yield, because I think we've done some damage, but I'm not lowering it very much. Okay, Steve asked, did volume of corn crop inputs show the trend in acreage increase in corn and reduction in soybeans? We try to pick up on some of those things. There were some indications of some modest changes, but not to the scope that we've seen here. Daniel, what should we see in crop conditions in the following week? Stability or increases? I think first stability and then second increases, yes, and they can increase rather fast. All right, it looks like all of the questions that we've had come in, other than the ones that the first ones that came in that I apologize that I'm not able to get to. If you had one of those first seven, actually first few were comments, but if you had questions there that I missed, feel free to reach out to me on Twitter. You can see my Twitter handle, Twitter address there, and do a direct message to me, and I'll be happy to try to get to you and to answer and respond. Do that at any time. And come to stonex.com and follow us there. We look forward to seeing you again for our July crop report webinar on the 12th of July. I'm excited for that. Next week, the markets are closed on Tuesday, and I will be out enjoying some time with my spouse next week, and so I won't be writing commentary. You won't see me on Twitter. Certainly look forward to things. Continuing to try to ration soybean demand in the market or long term. Now it'll have to decide what price will effectively do that. Has it gone too high or does it need to go higher? That'll be the debate through the weekend. About corn, we've got a surplus of corn and the market has to find a demand for that, and it doesn't do that with higher prices. Thank you all for being here today. Look forward to seeing you again on July the 12th. Thank you very much. Stay safe this 4th of July holiday weekend, and happy birthday to the United States of America.